And every 2 minutes, there was somebody predicting a 10,000 gold and a $200, $300, $400, $500 silver price. In a matter of 8 weeks, that sentiment almost flipped 180. I actually sold those positions. Let's not lose sight of the two main drivers for gold are still fully intact. Strong central bank buy-in and incredible increases of debt levels and fiscal irresponsibility. Yes, 3,500 is possible. It's not something I rooted for or predicted, but it is a possibility. People become extremely short-sighted now. There is a persistent, small-time rumor that come July 4th, for some reason, Trump is going to announce something to do with gold and potentially backing bonds. Is it possible? Yeah. If you're a gambler or a speculator or a trader, you wait for more of a pullback and think that the overwhelming belief on gold now is lower, not higher. Sometimes I think about, I don't want a $10,000 gold price, especially in the next 12 or 24 months. So I actually, when the market came off a couple of days, I actually sold those positions for a small gain because I decided to get back in halfway into the metals, particularly certain mining shares, and then left a level to enter the remaining amount if it would occur, and that happened this week, between 3,900 and 4,000 on gold. So I'm effectively full-fledged bull again. I'm as bearish as ever on the stock market, but I made a decision that I was more comfortable going long gold again than staying short the stock market. I guess that's the fairest and shortest way to describe it.
So as of now, what is your view on the stock market? Where is this bubble heading? And it sounds like you right now are more confident on your longs in precious metals than shorts in the stock market.
Yeah, just that. You know, I've always had a more comfort level and, of course, done better in the metals and never focused as much on the stock market as I did the metals. And I've been both long and short in the metals over my career. Just that, you know, just to recounter. And I think, you know, a lot of your viewers obviously are interested in bullion because of your business. But I think people lost sight of what transpired in the last 25, 26 years. You know, gold rallied so strong that it's outperformed stocks and bonds until this correction for 25 years. And the sentiment made a 180 again. I mean, you know, in January and February when I moved out is because we were in this tremendous parabolic rise.
Wall Street celebrates record highs while experienced capital quietly rotates toward hard assets instead of chasing momentum. As Peter Grandich points out here, shifting back into gold near the correction reflects changing risk-reward, not emotional trading. When seasoned investors reduce stock exposure but rebuild precious metals positions, they're responding to valuation gaps that headlines ignore. Wealth preservation often begins before consensus recognizes the danger. Next, Peter Grandich reveals why collapsing bullish sentiment may actually strengthen the long-term case for gold.
And every 2 minutes, there was somebody predicting a 10,000 gold and a $200, $300, $400, $500 silver price. In a matter of 8 weeks, that sentiment almost flipped 180. All those rocket ships and everything disappeared. A lot of people that were extremely bullish disappeared or moved to the sideline, and some even flipped to the quite bearish side. And then a couple of days ago, the bullish percentage index of gold miners went to 0. Now, I know it got down very low one time, but I don't ever remember it at 0. And so I just decided, been at this 42 years, sentiment is normally a good thing to bet against when it's so overwhelming one way versus another. But more importantly, let's not lose sight of the two main drivers for gold are still fully intact. Strong central bank buy-in and incredible increases of debt levels and fiscal irresponsibility. And so if you're long-term oriented, if you're not a trader and you invest for matters of months or better yet years, the story is as good as it was in January or February, but finally they became attractive to aggressively accumulate them again. And I'm speaking both for gold and silver, which is not normally something I used to use in the same sentence. But silver down here in the 50s was just another opportunity to get reloaded again. So call me a bull. Don't call me a bug because I move out of these things at times. But I just think they listen, I'm going to go on, so I'll just cut it here.
Markets rarely ring a bell when emotion reaches an extreme, but sentiment often does. According to Peter Grandich, bullish enthusiasm evaporated within weeks, even though central bank buying and expanding government debt never disappeared. That contradiction exposes how investors frequently trade headlines instead of structural fundamentals, driving long-term value. Those reacting emotionally risk selling precisely when institutions begin rebuilding positions. Next, Peter Grandich exposes why the biggest driver behind gold's future isn't investor optimism, but government balance sheets.
We went up 250% in a couple of years, and we were up 100 and something percent. Anybody that's been in bullion for a lot of years know that's extraordinary. That's not something you should expect or even continue. So it was an absolute healthy thing. No one likes going through them. But if you've really been buying gold on a belief it can go to 10,000, you're better off that it did this than it would have kept going in January or February. At least that's how I see it.
It does seem like a dramatic correction, but as you mentioned, in bull markets, that's very important at times. Some people do anticipate metals falling significantly lower from here. People are looking at that $3,500 level in gold and that $50 level in silver being key support. Do you anticipate much more downside from here?
So what I've said the other day when I went in, when it broke below 4,000 is, yes, 3,500 is possible. It's not something I rooted for or predicted, but it is a possibility. But even if that was the case, risk reward is what you have to measure. So if you're buying at 4,000, do you think there's more than $500 upside? I still say that, and I never moved away from it other than that we needed a correction, that gold is going to make substantial new highs and that the 10,000 number is a distinct possibility over a multiple of years. So if I have a $500 risk down and I have a 5,000 or more upside, if I'm not a trader and I don't watch day to day.
The biggest investing mistakes usually happen after healthy corrections, not before them. What Peter Grandich is highlighting is that disciplined investors evaluate asymmetrical risk rather than obsess over short-term price swings. Even if gold briefly revisits lower support, the potential upside still outweighs the downside over a multi-year horizon. That's the calculation institutions quietly make, while retail investors focus on daily volatility. Next, Peter Grandich reveals why short-term fear often creates the strongest long-term entry points.
If it does go there, okay. Now, people become extremely short-sighted now. The one of the negatives of people's abilities to look at things when 20, 30 years ago, you only could either call your broker or see it in the paper next day. Because they watch it and get caught up in the emotions of the trading, they shrink their willingness to be long, or even if they were that on the opposite side, short. And I think people need to step back and understand that this is not a product, an investment product, gold, that you should be very short-term oriented on. Remember, we all argued when it was 2000 and it finally broke. And if we remember, we had that 10, 20-year cup and handle. We all thought it can go to 5,000 or so. Well, it did. A 50% correction of that is 3,500. So is it possible? Yes. Should I lose sleep over it if I am a long-term investor? No. And quite frankly, if you're a bit concerned about it, hold some buying power back. And if it does go back there to that low, we can't say after this is just a technical bounce from this. We go into a very holiday atmosphere with one potential surprise for gold. I don't know who you've interviewed recently. I know you've probably spoken to some people about it. There is a persistent, small-time rumor that come July 4th, for some reason, Trump is going to announce something to do with gold and potentially backing bonds. Is it possible? Yeah. There's one person that's constantly spoken about it.
Every major correction feels permanent until history proves otherwise. Peter Grandich's argument suggests investors have become prisoners of real-time price feeds instead of long-term market cycles. Institutions know volatility shakes out weak hands before durable trends resume, which is why they rarely chase headlines. Protecting wealth requires patience, liquidity, and preparation instead of reacting emotionally to every price swing. Next, Peter Grandich unravels why rumors surrounding gold policy could distract investors from the real structural story.
But outside of that, we have a holiday atmosphere. If you really want to be certain, and you really want to, you're going to need several weeks of staying above 4,000 to say that that low just below it was the low. If you're a gambler or a speculator or a trader, you wait for more of a pullback and think that the overwhelming belief on gold now is lower, not higher. That's what changed dramatically in a matter of weeks. There's a more percentage of bearish views out there than there are bullish at the moment.
That's definitely key. I mean, I remember when we were hitting the tops in late January in gold and silver, it seemed like everyone was super bullish. You had one or two people we were interviewing who were saying, I'm selling my precious metals. You were selling as well. When we had the parabolic rise, but it was few and far between those voices who weren't extremely bullish and calling for silver to be hundreds of dollars soon. So it seems like, as you mentioned, it's really reversed now. And for those, I guess, who are looking long term, or even for yourself, are you holding back any buying power in anticipation of lower prices to come? Or is your view just, my view is I'm holding for 5 to 10 years down the road, so it doesn't really matter at this point, and I want to be all in?
Yeah, I'm all in, and of course I'm all in on shares as well.
Retail sentiment flipped from euphoria to pessimism in barely 2 months, yet institutional behavior rarely changes that quickly. This is where Peter Grandich's thesis shifts from chasing price to evaluating conviction across an entire investment cycle. Professional investors understand that widespread bearishness often appears before capital quietly returns to undervalued assets. Those waiting for perfect certainty usually pay much higher prices later. Next, Peter Grandich reveals why emotional consensus has repeatedly been the wrong timing indicator.
I always say this to you, and it's not a knock on your business, and I think for what you guys do, I wouldn't talk to you unless I thought you were reputable and honest. But my main concern about owning gold is to make a profit in it. Now, I've always said to people, and you know what, two things they should learn. They should realize that they thought they were the type of trader or whatever until it went down, and now they can't sleep at night. Well, they weren't the person they thought they were when it was going up. But the other thing you got to remember, gold served its purpose. When you've been talking about gold well under 2,000. I was talking as low as 1,300. And I kept saying from 1,300 to 2,000, listen, if nothing else, buy it as an insurance policy and hope you never have to call on the policy. Because it's a very inexpensive policy if a lot of things that we think could go wrong. Well, the world looked like it was ready to get into World War III. People had liquidity crisis. Wow, look at this. This thing I bought for 1,300, 2,000, 2,500. I can get my liquidity I need and get out at 445. It served its purpose. How many people can say that investments that they made served their purpose? So don't lose sight of that. Don't get all caught up in this, but also recognize that you can't keep listening to the people that are always sending up rocket ships, who are always bullish, who are always talking about a much higher number and all.
The real value of insurance only becomes obvious after everyone suddenly needs it. As Peter Grandich points out here, gold's role isn't simply maximizing returns, but preserving optionality during periods of financial stress. Investors who treat it solely as a speculative trade often misunderstand why institutions continue accumulating physical reserves. Wealth protection is measured by resilience, not excitement during bull markets. Next, Peter Grandich exposes why perpetual bullish forecasts can become just as dangerous as permanent pessimism.
That is not serving your purpose. Try to identify. That's why I said, and to respect still that there's some downside. There's one or two experts out there now that I have a lot of respect for who were very bullish on gold and now have turned bearish. And that's to respect their views. Just, I see the cup half full, they see it half empty, and we'll know in 6 to 12 months, who saw the cup right. But be careful of these people that just day after day, week after week, month after month, year after year, present these, all sorts of numbers, that the metal is going to go to and all. I always say this to you, Elijah, and you always allow me to digress and get into our Catholic Christian faith. Sometimes I think about, I don't want a $10,000 gold price, especially in the next 12 or 24 months, because what that means happen in the world may not be exactly a world I want to partake in anymore. But my job is not to input that. My job, what remains to our planning group, is to give a macro opinion on economics and markets, good, bad, or indifferent. And I think gold has come back to a level now where people can put it into their portfolio minimally as an insurance and secondary as a potential to make capital appreciation on.
The fastest path to losing money is confusing bold predictions with disciplined analysis. According to Peter Grandich, respecting opposing views matters more than following permanent bulls or permanent bears. Extreme price targets often generate attention, but they rarely prepare investors for the risks accompanying those outcomes. Long-term portfolios benefit from balanced positioning instead of emotionally chasing dramatic forecasts. Next, Peter Grandich reveals why a soaring gold price could actually signal a far more troubling global reality.
I used to half joke and say to people, I think it disappeared because somebody said, Mr. President, we may not want to do that just yet. My whole argument on it's been discussed as long as I've been involved in gold, from the early original Ron Paul. If all the gold is there and all the gold has not been lent out and it's not fraudulent and all, come on in, folks. Do whatever you got to do, Congress, do the full audit, take whatever time you want. The fact that they don't just tells me, maybe it's because, I'm from New Jersey, but something tells me something just ain't right there, okay? And I would think that if we were going to make such a dramatic move like that and literally say we're going to use all this gold, which supposed to be on the books is still one of the biggest amount of all in the world, we want to make sure it's all there and it's all ours. And we don't want to say it's now going to back new bond offerings, go over and get investigated and see that it's not all there. That'd be worse than never backing it at all. So some people say, well, maybe they did the audit quietly. Yeah, you can never say they didn't. So I have not been a big believer in this, but I do think the biggest story in it is to look at the countries that's already doing that. That's what the BRICS did. That's what helped drive gold where it was.
Official confidence means little if transparency never follows. What Peter Grandich is highlighting is that credible financial systems invite verification instead of avoiding uncomfortable questions. While headlines focus on hypothetical policy announcements, sovereign accumulation of physical gold continues across multiple nations with little public attention. Investors should watch verified actions rather than political speculation. Next, Peter Grandich unravels why global reserve strategy matters far more than election cycle headlines.
They're not walking away from that. What they just learned to do is, remember, you and I had this discussion, one of your shows, you can find it. When Trump says, I am going to break the kneecaps of all the BRIC nations because of what he said they were doing against the United States. What happened? The tariffs was reversed, like I told you. It turns out Americans paid for most of the cost. And the biggest thing I said, the allies who we were turning against, who we were hitting with this big stick, whether they deserved it or not, whether they treated us horrible all these years, the next time we had a major crisis, they're going to turn our back. And we just saw that in the Middle East and all. So what I think the BRIC nations and other nations that have been accumulated, China and all, said, listen, he's basically done. But, he's a hothead, so he's got to November. It looks like the House is going to turn Democrat. He's going to have no time to play in the geopolitical world and all and everything and all. So I just think they go about it. We know China just keeps reporting more and more accumulation. And then they'll go back and, go forward with what they planned. So I think the talk of having gold backing something is very useful. Is it going to change the United States in a big way? No. It helps momentarily, but when you're at 40 trillion heading to 50 or 60 trillion, to the point where you might not even be able to make your interest payments, I don't know how valuable it's going to be for a very long period of time.
Governments often change tactics long before they change public messaging. Peter Grandich's argument suggests geopolitical rhetoric may fluctuate, but reserve diversification and sovereign gold accumulation continue beneath the headlines. Investors focusing only on speeches can miss the steady repositioning occurring across central banks and major economies. Debt dynamics eventually overpower political promises in every cycle. Next, Peter Grandich exposes why growing sovereign debt may become the ultimate catalyst for precious metals.
Well, Peter, it's always a pleasure to speak to you, especially regarding these very timely topics. It seems like things are really coming to a head here soon. And it is, I guess, encouraging for a lot of our viewers to hear that you're all in and on gold, silver, and miners, that you're still long-term quite bullish in the sector. Before we let you go, did you have any last thoughts for our viewers?
Well, I just think that they need... people become too short-sighted and too short-term oriented. And I just think you need to understand that, do you have the proper procedures to go forward and not be part of these terrible things that some of the gold forecasters talk about? Well, the first is you got to spend less than you make. The second is you have to live within your means. And some people, you have to live under your means. And the third is you have to have a purpose to think of something more than items or things are going to make me happy. And I think what happened in January and February is people got caught up in not just the underlying reason for gold, just the fact that it can go up a lot, I can make a lot of money, and then I can do all the things that are going to make me happy.
The greatest financial risks usually begin when discipline gives way to excitement. This is where Peter Grandich's thesis shifts from market forecasts to investor behavior, arguing that lasting wealth comes from consistent habits rather than chasing spectacular gains. Markets reward patience far more often than emotional decision-making, especially during volatile cycles. Protecting capital starts with controlling expectations before chasing returns.